That's very important because global rating agencies like S&P and Moody's will be looking at that figure to determine what your sovereign rating should be, and hence it can have an effect on the value of the ringgit in general. So at a glance here, you can see that the government's income is 340 billion. It's committed to spend 335 billion in OPEX and 86 billion in development expenditure. The shortfall is what we call the budget deficit. So all in, it is committed to spend more than 421 billion. Now, of course, a lot of this revenue is funded from your income tax, corporate income tax, and also almost half of it from the Petronas dividends, right? Okay, so but what are the major points? What are the new talking points about this budget here? Is that I think, as I've noted here, number one, the government is trying to expand its revenue base, trying to increase a little bit more income from other sources. So one of the main tax that they have announced is that the service tax will be expanded from May 2025 to include some of the other services too. For example, some of the banking services which are not taxed, they may look into it. So basically, it try to cast a wider net to other economic activities that requires to pay service tax. There are no details yet at this moment, but we can expect further elaboration from the government on this. And then there was also a surprise 2% tax on dividend income for individuals who receive dividend income more than 100,000. So basically, it's trying to tax the slightly high income and richer people who get a lot of income from dividends from all these listed shares. Yeah, that's starting from 2025. Also, there will be a new carbon tax for certain industries like iron, steel, and oil and gas. And also the sugar tax is also increased from 50 cents per liter to 90 cents per liter, basically encouraging people to, of course, consume less sugary drinks, right? And also another major announcement was the petrol that we pump, RON 95, the government will not reduce its subsidy right away. It will only do so in middle of 2025. And even that, it will only target the top 15% of income earners. So what mechanism the government is going to roll out, we don't really know yet. I think they have mentioned that they might want to use things like you need to swipe your IC when you pump petrol, or maybe use your digital wallet so that they can identify who is eligible for subsidies and who is not, right? Okay, so it's good news for you and me that okay, the subsidy will still remain in place for the next 9 months. So another major talking point is the minimum wage increase. So the government here is clearly trying to lift up the sort of the bottom 20 income earners. So minimum wage is going to be lifted from 1,500 to 1,700 ringgit effective from February. And also it has declared that foreign workers may also need to pay EPF going forward. Okay. And lastly, there is like the expenditure to East Malaysia in Sabah, Sarawak will get 6.7 billion and 5.9 billion respectively for development. So that's a big increase for East Malaysia. So those are the few main points that I believe are more pertinent in this current budget. That's more on a sort of top-down macro basis. Okay, now on individuals, right? I'm sure a lot of you are also, if you've not read the budget, so you also be interested in, what's in it for you, right? As an individual. So I just like to point out that, okay, my first point here is that I think one of the more major individual tax relief here is that the limit for premiums on education and medical insurance for yourself, for people buying for themselves or their spouse or their children, that relief will be increased from 3,000 to 4,000 ringgit from year assessment of 2025. So that's a very sizable increase in terms of how much you can deduct from your income and claim back from LHDN. Okay, that's I think a very good selling point for all life insurers out there. Next is the individual income tax relief for first-time home buyers. The relief is going to be up to 7,000 for people taking up housing loan up to 500,000 and 5,000 ringgit relief for a housing loan between 500 and 700K. So that basically will benefit the property sector and also the younger first-time home buyers. And also there are other small nitty-gritty expansion in terms of income tax relief. I won't really go through each one of them because I believe they are quite minor, but it's useful for a lot of individuals. Like for example, your full medical examination can cover your cost of vaccination and other things like your medical expenses can also you'll get tax relief for not just your parents, but it will include your grandparents and all that as well. And the tax exemption on childcare allowances will also include elderly people. So it's a very sort of a slightly more inclusive budget that the government has, that the PM has dished out this time round, right? So okay, let's examine a little bit closer as to what this budget means basically for the sectors and the industries and basically the investment market and investment climate in general. So generally, as the budget as a whole, we believe generally is quite neutral for the market because there are no big announcements that has negatively surprised anybody. The government has refrained from implementing GST or they have not changed the corporate tax rate. They have also basically maintained status quo on a lot of the tax issues that we're talking about. There's no inheritance tax and stuff like that. So I think the main point that I pointed out was that minimum wage is going to increase from 1,005 to 1,007. That is the one which might impact corporates a little bit more. So I think running through some of the sectors now, what I projected here is that these are the budget's impact on these particular sectors, right? So you can see most of it is quite neutral. It's positive on things like transportation, where we will have, Visit Malaysia here in 2026. So there will be more tourist flow and so forth. And then those income tax relief for first-time property buyers will be positive for the property market. Some of the other announcements or issues will be basically, the impact will basically be neutral on all the other major sectors like utilities, consumer, and construction. Construction basically is more neutral to positive because the government has continued to commit themselves in terms of the development expenditure budget of 86 billion for 2025. Now, it has to be pointed out that I think the PM has basically explicitly mentioned that there will be no mega projects over the next 1 or 2 years, but they will continue to spend on basically what's needed and the basic projects that are required amongst all the states in terms of developing the more less developed states in basically East Malaysia, southern part of Malaysia, and so forth. Some of the slight negative, they're not really that negative. It's like, as I mentioned, the extension of the service tax that might impact the financial service sector a little bit. And also, of course, when the RON 95 rationalization comes, it could be slightly negative for some of the oil and gas players as well, given that we will maybe be consuming less petrol going forward if they are a lot more expensive, right? And also for the glove sector and the manufacturing sector in general, We think that especially those who are employing a lot of foreign workers, they will see their labor costs move up because of the minimum wage increase. So that includes some of the glove companies out there as well. So all in, we think that on balance is basically a more neutral budget towards some of the most of the industries and the sectors in the economy. Okay. Okay, so I mean, just quickly flesh out. I talked a little bit about the development expenditure. You've heard about the term the Madani government. It's supposed to be very inclusive. Development is more spread out towards the entire Malaysia, and quite a lot of, as I mentioned, development expenditure will be spent on other states outside of Klang Valley, basically building up. Government's trying to build up the southern region, as well as East Malaysia in Sabah and Sarawak. In Johor, obviously, there has been a lot of excitement about Johor. Basically, there's been a lot of foreign investments from a lot of big companies like Microsoft and Google coming in to build data centers around the southern region. And I think that this theme will continue to be played out in 2025. So there will be quite a lot of economic activities going on in Johor. A lot of things are quite buzzing. Land prices there are moving up very quickly, and there's also this this RTS link going into Singapore from Johor Bahru, which will basically increase obviously the linkage of people and goods from Malaysia to Singapore. So I think it's basically a very good land value enhancing project with the rapid transit link to Singapore. So people, investors as well, are getting quite excited about this. And the government has also announced all the special economic zones within Johor, the 6 areas, which will have special incentives for a lot of businesses and also to attract more foreign direct investment coming in. Sarawak also is like full of projects. We have the various sort of economic corridors, within the Kuching area, Bintulu, Miri. There's petrochemical hubs. There are high-tech hubs, which the government will continue to increase the development expenditure and also continue to develop these places and attract more investments to go in there. So it's going to be quite busy overall. And so with that in mind, I think when we look into the Malaysian stock market in general, we are still very positive on Malaysian equities over the next 12 months. As I mentioned, I think budget 2025 will underpin the expenditure into the various industries and the various projects. So things like fixed income, so fixed capital investment will be very high, and employment will continue to be quite high. And I think this will also underpin corporate earnings going forward into next year. And what's also quite positive is that the government has committed to its fiscal consolidation of reducing its fiscal deficit to next year as 3.8%. So basically, that's quite positive for the country's sovereign rating. Hence, we can expect more stability, if not some further strength in the ringgit over the short to medium term. So I think with that backdrop, I think the Malaysian equities market will look attractive for foreign investors, especially when we have a global rate cut environment still going on, right? I think as some of you might know, the US Federal Reserve has already started to cut rates by 0.5% back in August. They have committed to basically reduce the rate over time. Basically, the speed of it will depend on the GDP growth and data. So I think over the course of next 12 months, as you can see here, I put the chart here, that interest rates are expected to come off, from close to around 4.8% down to the 3.5% by sometime in the middle of next year. So when we have global rate cuts coming, this will encourage more fund flows, overseas fund flows coming into emerging markets like Malaysia. Basically, I think, the Malaysia has not been a very favorite market amongst foreign investors. As you can see, the market ownership has been coming off slightly. So ownership is still low, so that means that there's still a lot of room for them to increase their weightage of their exposure to Malaysia. And I think when the flows do come back, we will have a much stronger performance in the KLCI in Bursa Malaysia in general. Yeah. Okay. So already, like, on a year-to-date basis, this year in 2024, up to September this year, Malaysia has been the best performer already amongst all ASEAN countries, right? We've recorded just 9 months alone, the 13% return, which basically beating Philippines, Singapore, Indonesia, and Thailand. Now, why is that so? It's because I think, number one, post the last general election in 2022, I think we have fairly good political stability as compared to our neighbors. Yeah. So Mr. Ahmad Ibrahim is in his, I think this is his third year. This is his third budget already, his third year in office. So there's another 2.5 years to go. So I think our political environment will remain quite stable. That will attract a lot of both portfolio investors overseas as well as FDI, which is very important for the country. And also, I think some of our fundamentals have been also been superior to some of our ASEAN neighbors, for example. And I think our GDP growth, which was the last announcement for third quarter 2024 GDP growth was, I think, around 5.3%. Now that's a very good number, even beating the government's expectations slightly. And it's also trending higher than what our neighboring countries are doing at this moment in time. So I think Malaysia still has a pretty good story in terms of both politics and also the economics, and also the fundamentals of corporates are all quite strong, and hence I do foresee further upside into 2025. Okay, some of the sectors that I just want to flesh out that has done really well this year. Construction has a lot of construction stocks has gone up a lot. This is largely because of the push of the government behind a lot of the projects. There has also been a lot of foreign direct investment flows, especially, as I mentioned, in Johor, especially a lot of land being bought up to build data centers. That has all been very positive for the construction industries, and those companies are expected to have very high earnings growth over the next 2 years. Yeah, so the related plays are, of course, utilities in terms of big companies like Tenaga. The power consumption, obviously, when the economy is doing well, power consumption is going to be very strong. So I think utility stocks have also performed along in line with that. Property, as I told you, has been a lot of high value land sales, and even our property market has actually been a lot more buoyant, right? After coming out from COVID. So there's been a lot of more residential property sales reported by the various property companies. The numbers look a lot stronger these days. I think people have more confidence to come out and invest or buy their first homes over the last 1 year. And I think that will continue to happen. Okay, so some of the other sectors are also have been very strong, like finance, like REITs have been doing well, healthcare, and so forth. But we believe that some of the investors will basically rotate into some of the sectors which have been lagging, like, for example, consumer, plantations. These are more cyclical sectors that sometimes will, after a period of low expectations, the demand might come back in 2025, which might drive the stocks up again. So I think we are actually well invested in a lot of the sectors that are showing quite good, strong fundamentals and prospects going forward. Okay. So as I mentioned, I think the budget is good in terms of supporting corporate earnings. The government itself has also recently announced that that GDP outlook for next year is going to be higher, and it will trend from this year. I think we're likely to hit maybe around close to 5% in 2024. We still have 1 quarter to go, but next year the government has already upped its forecast to say that GDP growth will be around 4.5% to 5.5% in 2025. So this will augur well for corporates in general, where we expect that corporate earnings growth. Now, corporate earnings growth is very important for the stock market. We expect earnings growth to grow more than 8% at this juncture for both 2024 and 2025. I think there could still be some upside surprises in terms of the profits that a lot of listed corporates can make. For example, some sectors that we still favor are like the financials company, the banks, for example. We still think that loans growth, for example, driven by better consumer confidence, property demand, corporate loans, those will drive bank earnings going forward. We believe that utilities also will be very well supported in terms of their services. So the earnings from utilities will still be pretty good. REITs will be steady, and commodities selectively and tech selectively, right? Some companies may not have done so well this year, but the cycle is likely to come back and turn in 2025, especially when the valuations for some of these stocks look, more attractive. So you can also see that the chart that I put in there on the right-hand side, right? Whenever we have a strong period of ringgit strength, right? Our ringgit basically has moved from almost to a low of 480 back to around 420. I think today is about 43 something. So there's been a period of good ringgit strength. Following that, usually the stock market tends to perform quite well as well when we have a lot more stability in the currency. Okay. Now, so underpinning this, I need to talk about what is happening in the world as well, right? So this projections came out from the IMF just a few days ago. So essentially what the message is that global GDP growth is going to be quite stable. In 2025, they expect the global economy to grow by around 3.2%. In general, that's for the whole wide world, right? Of course, the advanced economies like the US, the developed European countries, European Union, those will all grow slightly lower at 1.8%. But for emerging market and developing economies, which of course includes Malaysia, the growth is going to be much higher than the rest. It's going to be quite stable at around 4.2% in general for emerging markets. Now, as I mentioned to you, Malaysia is likely to grow at close to 5 and 5.5%, which will be better than the average emerging market. Yeah, in general, basically. So I think global growth will basically be quite stable, and that will augur well for both financial markets and businesses as well. Now, I mean, since I'm talking about global and external factors, I think some of you may be thinking, okay, are there any risks going to next year with what's happening around the world? I think one event that obviously a lot of investors are looking at is the US presidential election that will take place in November. Of course, there's a two-horse race between Donald Trump and Kamala Harris. The race is going to be very tight. I think nobody knows who's going to win because early indications are like there's going to be it will depend on the 7 or 8 swing states to determine who is going to be the next US president. Now, why we say that it is a little bit of a risk because the policies of Donald Trump and Kamala Harris are slightly different. Both the Democrats and the Republicans have slightly different economic policies when they are in power. The risk, of course, is more tilted towards, for example, Donald Trump where he has mentioned that he will slap much higher import tariffs on a lot of countries, especially China. And he specifically said that he is likely to slap as much as 60% tariffs on China and some of the other countries that export a lot of goods to the USA. So that could be, a slight economic risk if a global trade war takes place. So we'll see what happens. Like I said, it's like a toss of a coin, 50-50, who's going to win. But I think we are quite vigilant on the watching that result. And of course, there are some geopolitical risks. We all know what's happening in the Middle East and Russia, what's happening in Ukraine. The war is still ongoing, and there's a lot of tension at this moment in time still in the Middle East, which hopefully can come to a peaceful conclusion and not escalate. So that will augur well for markets in general. So those are like I think risks associated with the outlook for next year. Okay. So I'll move on to talk a little bit about fixed income strategy. Generally, the message here is that we believe that the fixed income market will continue to be stable, especially the Malaysian bond market. The chart that I have here is that you can see the lower blue line is our Bank Negara OPR rate, right? Since it was moved to 3% in the middle of 2023, it hasn't changed over the last 18 months. We believe that Bank Negara will leave the OPR rate unchanged at 3% for the good part of 2025. So that will basically anchor the stability in terms of Malaysian treasury yields and the Malaysian corporate market in general. Basically, when we say that the spread has generally tightened a little bit because of what happening in the US, where there has been a rate cut, and there could be continued rate cuts that could impact the bond market globally as well as Malaysia. But generally, when they have a rate cut, when you have rates coming off, then the prices of bonds also tend to move up a little bit, but not by that much. So I think our strategy there is also to remain invested and to position to gradually re-enter the market when the yields are a little bit higher to get better returns. But all in, I think the fixed income market is likely to remain very stable next year. So yeah, in terms of the total debt securities which are held by foreigners, I think you can see on the bar chart on the left, right? The last few months, we've seen quite very strong inflows from foreign investors buying into the Malaysian bond market, and that's largely because the confidence level of Malaysia has moved up, both in terms of the fundamentals of Malaysia, the political stability, as well as the flow of funds coming from the rate cut in the US. So I think that augurs quite well, and I think the that number is likely to move up a little bit higher into next year when there are more substantial rate cuts in the US. Basically, the foreigners come in, they usually buy government bonds, and they tend to hold it quite long term in general. Yeah. So yeah, we expect rates to be interest rates to be and yields to be quite stable going forward. Okay, so I'll quickly just move on to this chart to talk a little bit about our investment-linked fund performance, particularly focusing on equity funds. Now, this fund shows a 6-month return of all the investment-linked funds in the market, and also shows the top 10 performing equity funds out of the whole universe of funds in the market. Now, basically, my message here is that I'm quite happy to say this, as in our HLA equity funds over the last 6 months have shown tremendous return over this year. And as you can see in this chart, out of the top 10, 6 of the funds belong to Hong Leong Assurance. Okay, and the returns range from 11, 12%, or up to 13% just within the 6 months. And we look at it within 1 year, as highlighted in the yellow boxes. The returns are all very strong. We range from the low teens, 12, 13, all the way up to 26, 27%, especially for the Hong Leong Smart Growth Fund. Right. So the performance, I'm quite happy to say the performance of the all the HLA equity funds have been very strong, basically in comparison to both our benchmark and also in comparison to all our competitors. Notice that this ranking here is has more than 112 funds, all within the industry of all insurance companies. So the source of this table is actually from Liam, right? So if some of you recall, basically, a year ago when I did this investment outlook talk, also after the budget, some of you recall, I basically said that 2024 is going to be a good year for the equities market. And it's a good thing that the market and our funds has delivered very strong returns, for the past 12 months, and I'm quite happy to that. So I'm kind of like slightly repeating that for 2025. Yes, I still think that it's still going to be a good year for the equities market. And our funds are likely to continue to perform as strongly, and the returns are also going to be positive and will likely to beat the benchmark as well. Of course, the quantum of it may not be as high because we've come up to a higher base, but the returns will continue to be fairly strong, right? So I think our equity product offering here, has been quite strong. But if you want, of course, the higher return funds obviously have carried a little bit more risk in terms of their strategy. They can be a little bit more volatile. That goes without saying. Higher risk is higher returns. But if you prefer something which is of slightly more stable and less volatility, the funds like Blue Chip Fund and our Venture Growth Fund will be also quite ideal. So those funds are all ranked in the middle pack at this moment in time. Okay. Also, a similar chart, similar table here as well. This one I stretched the return to like 1 year, for example. We still have over the last 1 year, 3 HLA funds within the top 10 with very strong returns, very commensurate with the top 3 or top 5 funds in the market. I think there's you can see that there's very small differential, right? The Hong Leong Smart Growth Fund is, although it's ranked second, it's 0.02% away from the top fund. So it's delivered 27% return just on 1 year. Our Dividend Growth Fund, 25% in 1 year. Our HLA Venture Flexi Fund also very strong at 22%. Basically all ranked in the top 10 of all the comparable funds in the market, and there's 112 of them. And some of the other funds are all also the more stable funds are all bunched up in the sort of middle bracket of the ranking, because not all funds are have the same strategy or have the same same risk profile and the same volatility. So they do kind of perform differently at certain periods in time. I'm also proud to show you this fund is because like most of our HLA funds are more Malaysian centric, right? They invest more towards Malaysian equities, right? But basically this universe combines everything from the insurance industry. Basically to say that they have some foreign funds, they have some global funds, they have the Asia Pac equity funds as well. But they need not be performing all the time. let's say, for example, we in this table, the fund which is ranked number 5 is actually a Zurich India fund, for example, right? So sometimes we are not comparing apples with apples, but as I mentioned, most of our funds are invested in Malaysia, and it has delivered very strong performance for us over the last 12 months, and I'm quite delighted to project this. Okay, so the last section of my presentation is more on some of the individuals' funds specifically. I won't go through all of them because we do have a wide suite of equity funds as well as bond funds. So, but just to I've mentioned this fund already to you just now. This is the Venture Flexi Fund. It has been performing very well over the last couple of years. As you can see, it's been both absolute return has been very strong, and the relative return against benchmark has also been strong. I do like the fund, the Flexi Fund, because it has a lot of flexibility in terms of the asset allocation, which can be between 30 to 95%. So it can be fully invested in equities, but in a weaker market, we can tilt the asset allocation back all the way down to 30%. So I think that plays well into the investment objective of growing the fund over the longer term, investing in sectorial and investment themes. So the stock picking has been good this year. This is one of the stronger performers. Our managed fund has been also very consistent, throughout the years. It's been consistently beating benchmark, as well as the absolute return has also been quite strong. Over the past 1 year, it has delivered more than 12% returns. Okay, so moving on to a fixed income fund, which I think a lot of your customers may be invested in. So this one, of course, has a long, consistent track record. It's stable. It's low volatility. But I think in the short term, over the next maybe 1 year or so, the returns may not be as good as I mentioned in comparison to equity funds, which I think will perform much stronger than a bond fund over the next 12 months. But if you have customers who don't like volatility, who wants more low risk and stable returns, then of course the venture income fund will be the choice for them. Okay. So this is the blue chip fund. Blue chip fund, as the name suggests, we buy into the large cap blue chip funds mainly, and it also has shown quite consistent returns against the benchmark for both capital gains and dividend income. Okay, and lastly, this is the growth fund. Of course, also we try to be more tilted towards growth companies. So sometimes the fund can be a little bit more cyclical, but when growth returns strongly, I think this fund will also benefit greatly from the stock selection. Okay, okay. So basically that ends my presentation in general. I think, I think we still have 10 to 15 minutes where we can have some question and answer time.
Yes, thank you. Yeah, thank you, Rudy. Thank you for your sharing on wonderful. So, on your sharing itself, right, the key takeaway, there are a few points, right? First point is right, on the equity market is still very healthy, very positive sign for us, right? So that it really can help on our equity funds as well, right? And also on the fixed income side, right? Fixed income, our bond fund, right? All those is it is still in a stable performance, right? Of course, we can't compare with equity, right? But it's still giving a stable return from there. So questions here, right? They have some questions is already posted in here, right? So really, the very first question here is, right, which funds have taken profit to prepare for the re-entry market?
Sorry, Eddie, can you repeat that question?
Okay, the question will be, right, which fund have taken profit to prepare for re-entering market? Which means have any funds or any our funds, right, have do some adjustment, right? And
Oh, okay.
going up.
Yeah. Okay. Generally, we always take profit. For example, we always take profit on a lot of stock winners that we have that have done really well. For example, some stocks, so some construction and utility stocks like I like YTL Power, for example, has done very well last 12 months. We've taken profit on some of them, and some construction names also we have taken profit. But we still remain invested overall in general. We still remain quite highly invested for a lot of the equity funds. We still have equity weighting of around 80 to 90% basically. And I think we do keep a little bit of 5 to 10% in cash for any opportunities that may come about in terms of some stocks that we can refine which are undervalued, or another positive theme or development could be coming to re-rate the stock higher, then we will buy into them. And also, I think the Malaysian capital market last 1 year and even going forward has been a lot more buoyant, for example, right? And I think this means that there will be quite a few more IPOs coming where we can also participate in as an institutional investor. I think we all know I think if there are investors out there in general, we all know that there's been a few listings. One of the more higher big profile listing was 99 Speedmart, which we participated in, and the stock has done very well over the last 1 or 2 months. So we do have these sort of opportunities that we can come in and basically enhance those returns.
Okay, thank you, Rudy. The second question here will be, right, with the government of Robin Hood strategy, right, in the latest Malaysia market, right, is target on the T15 category, so the income group. So what do you think, right, okay, on your point of view, what do you think, right, could it impact this demography? Will their overall cost of living increase? And do you see the opportunity of a sales opportunity for insurance industry?
Okay, yes. Now basically our government, like I said, is quite inclusive. It tries to protect the low and middle income people. So the petrol subsidy, as they mentioned, will only target the top 15, essentially the top income earners. Where the cutoff is, we still don't know, and what mechanism they use to differentiate high income and the rest of the population, we still also don't have any details. But I think as long as the target to basically tax the rich more, or rather not subsidize the rich, and also not to subsidize foreigners, for example, who are staying here in Malaysia, then I think it wouldn't have much impact on the general population spending power in general. But yes, a good point was raised in the sense that when these subsidies are reduced and your petrol prices move up a little bit, it might increase the general cost of living for people in general, because inflation could tick up a little bit, given that petrol prices, basically transport companies in general, for example, will probably have to face a higher fuel costs, and that can be passed on to some goods and services, right? But the government is, of course, very careful with this, is very careful with maintaining a low inflation number. So I think the subsidy withdrawal will be very gradual. So it won't have a one-off impact or major impact on the consumer spending power. So I think if someone asks about consumer spending and I think sales of life insurance, I would think that the more overriding impact would be the health in the general economy, which is going to be stronger over the next year or two. Stronger government spending, stronger consumer spending more tourist inflows and all that, that will augur well for the economy in general. So it will help people maintain or at least increase their income in general and have more disposable income to spend on things like insurance policies.
Okay, thank you, Rudy. Following questions will be why technology sector with negative return?
Oh, okay. Technology sometimes is the budget itself, just on the budget alone. A lot of our technology companies are more like manufacturing companies. They are more like electronic manufacturing services with plants around Penang or Johor and all that. And some of these companies actually employ a lot of foreign labor. Like I mentioned to you, the minimum wage increase will hit the foreign labor costs. And also, I think the government also wants foreign workers to pay EPF, for example. But I hear that employer contribution is not needed for foreign workers. So I think this will impact them a little bit because labor cost is quite a significant part of these companies' cost structure. So in the short term, we might see the margins come off a little bit. But having said that, everything is all to do with prices also, right? I think the technology stock prices have also come down a lot the last 2 to 3 months, and that's because of the end demand for some of these technology or electronic goods have not been so strong globally also. So these are also cyclical factors that we have to monitor. But the cycle usually comes back when it usually goes under a very low cycle where demand is low, and then when supply is not so great, then if the global economy picks up, then demand will come back, and then some of these stocks will outperform again.
Okay, great. Then, the following questions, right, is our HLA fund, right? Is this more preferable is a Malaysian equity market? Will they have a chance, right? We explore to foreign equity market as well for our fund exposure?
Yeah. Yes. So the bulk of our funds are, as I mentioned, invested in Malaysian equities. But I think there is like for example, our blue chip fund and the growth fund, there are opportunities to also invest a small portion into other equities market, for example, in the Asia Pacific region, where we do see some opportunities. So that depends on certain sectors and certain stock selection. But by and large, we tend to have more of the invested amount in Malaysian equities, where we believe our expertise are the highest, and there's I think ample room to derive what we call alpha, because we are on the ground, and we can enhance returns by going out to see the companies, knowing the companies well, and knowing what are the investment drivers that can enhance the value of the fund. Okay. Now, I think we also have launched not too long ago our global ESG fund, which is essentially more global in nature. At this moment in time, the fund is mainly invested in the US market. Also some of the very good US companies are in there. So if you have any interest in having more exposure towards the international stock market, especially US, then our global ESG fund is one to watch out for, which I think can do quite well also next year.
So for continue on our funds as well, so we will more focus on the semiconductor industry. Will that have a strategy that you want to move more into semiconductor industry?
Semiconductor, we try not to invest in semiconductor companies all the time because, as I mentioned earlier, semiconductor stocks are also very cyclical. Sometimes the demand is strong, and then it comes through various cycles. Sometimes you have oversupply, then the margins of these companies will be impacted negatively. Right now, we believe that the recovery of the semiconductor cycle is not taking place yet. I think we will see some consolidation still over the next couple of months, and perhaps by the second quarter of next year, we will see a more meaningful recovery for these companies. Yeah, and having said that, there are actually not many large semiconductor companies listed in Malaysia. There's only a handful of names like MPI, Unisem, Inari. Those are the few big ones that we usually look and track very closely.
Thank you, Rudy. And there are a number of questions also, but we will see the time how it work. And the following question, right? Just now on your sharing, right? You do mention that we have a dividend tax, right, of 2%. So will our fund also applicable on this part?
No, that dividend tax is we are exempted. Institutions are basically exempted from that tax. It applies only to individuals.
Okay.
Yeah.
So okay, this one, let me have a look. On this one. Okay, a question here, right? What is your forecast, right, on the coming next year on the global market?
On the global market. On the global market, I will always separate the global market into two tiers, right? One is the developed market, which is US, Japan, Europe, essentially. So those are the more big global markets. My outlook for them is that it will continue to be positive for them, but the upside is not going to be as high as emerging stock markets, because we think that, with, as I mentioned earlier, with the global rate cuts coming, it's good for equities market in general, but more of the funds, global funds, will start to kind of move out of the developed markets like US and come into emerging markets like us, which have been lagging behind a little bit. And also there's, in terms of the valuation, the emerging markets are also cheaper. So they would probably derive more growth and alpha in some of the smaller markets like in Asian markets, for example. But in a nutshell, I think the global environment, as I put it just now, global growth is continuing to be quite healthy and all that. So I think that will basically be good for the stock markets. And generally, right, if Donald Trump becomes the US president, he will probably come and start cutting corporate taxes. He will do all sorts of things to boost the economy, possibly. So yeah, so that is, one good point from, if he comes into power.
Thank you. Rudy, I mean, this will be the last question. Looking at the time, this will be the last question, right? And this question is focused on the Venture Global Fund, right? The question is on the Venture Global Fund. So a question would be, right, on the current Venture Global Fund, right? It's not that performing. Okay. So what is your comment? What is your view on the coming for this fund performs? I mean, any things that we have done on this fund?
Yes, I know they are. That this is one of the so-called poorer performing fund, which is not done as well as the others. I'm working quite closely. This fund is actually managed by Hong Leong Asset Management. So I'm working very closely with the team in Hong Leong Asset Management to basically try to restructure the way the fund is run and try to change the strategy a little bit more and align towards the other funds which are similar to the other funds which are performing better. Basically, so I think that could be a change in. Actually, we have been talking about this. There will be immediate changes to some of the strategy on that particular fund, and we try to be a little bit more active towards stock picking in Malaysia. Yeah.
Okay, thank you.
Mm.
Thank you, Rudy. Ladies and gentlemen, yeah, I definitely thank you for your question at first place, right? I can saw a number of questions is continue coming in, but unfortunately, I need to stop the presentation here, right? Before we end, really appreciate and thank you, Rudy, for your time, right? To give us the sharing, right? The podcast also and how our view is, right, for the coming our equity and also our income funds, right, for now and next year 2025, right? So thank you so much, Rudy, and thank you so much, my HLA partner, for joining us, right? Hope you get some things right and you're able to share to your customers, right? And things to take away from here, right? Thank you so much, everyone.
Thank you, everyone.
Thank you, Rudy.
Thanks, Eddie.
Thank you, Rudy. Thank you.